is a joint analysis between the KAIST Advanced Institute of Science and Technology and University of St. Gallen. My name is Charles. This group consists of Heian and Hidon and Paul from Germany, and we'll be analyzing the automotive industry. This is the table of contents, a lot, but we'll go through all of it. So number one is the market capitalization of the three companies. The top right here that you see here is the market cap of Volkswagen. So it is the biggest company out of the three. And the very bottom is the Hyundai, and the middle is GM. So you can see how their stock price has done so far and how the market participants have reacted to the performance of these three aforementioned companies. So there's a 30,000 feet view of the three companies, meaning that we'll compare to see the market capitalization with the price to book ratio. And there's three companies mentioned previously from the other colleagues uses US GAAP for GM, IFRS for both of the two rest of the companies. And so the one thing to mention here is that manufacturing firms like car companies usually have lower than one book value. And that's because their assets can only be sold at 1 times maximum. That's why you see for Hyundai and both Volkswagen, you see a book value of 0.49 and 0.75, so it's a discount. However, the only one company that trades at a premium is GM at 1.097. And why is that? We'll take a look at why that is. Same thing, a 30,000 view, but market valuation, price to earning ratio has been diverging between the market capitalization and also the earnings, meaning that the price is underpriced compared to what the earnings have grown so far. However, with the price to earning ratio of the other two companies, we see that price is coming down with the price to earnings going up, meaning that earnings is not supporting the valuation of the prices. And so another way of saying that is that we see this consistent growth in the basic earnings per share for GM, doing fantastic. That's why the price to earning ratio is coming down, so it might be another opportunity to buy this company. We have the Hyundai Motors. In this case, we have consistent downward trend of the EPS coming down. Not a good sign of this company. And same story, but kind of consistent with Volkswagen. So the only company that's doing very well is GM. So if you look at the top line growth, meaning why is the stock price of these three companies the way why they are, if you look at the revenue, GM is hitting all-time high revenue, meaning that they're capturing more of the market share compared to the other companies. And also, Hyundai, their revenue has been going down, 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 down. So is Volkswagen. So they're not as competitive in the market anymore. One other thing to note that's very interesting here is the volatility of their revenue. Hyundai is not doing a very good job in terms of mitigating the volatility in their sales. However, the Volkswagen and GM does a very fantastic job of doing so, meaning that for the investor's point of view and also the creditor's point of view, that's a very good thing. So this is all in one picture. So, in terms of the cost of capital, if you were to invest into these three companies based on what kind of accounting ratios that they have, we see that the GM's P ratio stands at 5, so it's about 5 years to double your money based on if the world completely ceases to grow and it does exactly, people consumed exactly the way they consumed, and people made exactly the way they made, then GM, it will take 5 years to double your money. Hyundai 7.8, Volkswagen 11.89. So what does that mean? That means for you to invest into these companies, the cost of capital will be 20%. So you should expect to make 20% a year, fundamentally, actually make, not from stock price rise, but fundamentally expect to make money at 20% for GM on an annual basis, and 13% for Hyundai, and 8% for Volkswagen. But has these companies done that before? Has it done for the last 5 years? And we can see clearly that for GM, it went from 5% ROE to up to 35% ROE, maintaining, again, emphasizing that this cost of capital is met, meaning that the company fundamentally provides a return for its investors. However, if you were an investor of Hyundai, you would have been wrecked. Because right now, ROE stands at 6.47%, and the current market valuation of Hyundai is at 13%. So they're saying next year this company should be making 13% through operation, but history has shown that Hyundai cannot do it, or Hyundai's management has some serious problem providing that kind of return. And same with Volkswagen, it's been consistently coming down, disappointing investors. So, if you break down the ROE, so what is happening to their ROE, it gets very interesting. Because when it comes to GM, and we saw that huge growth in the EPS, well, that's through their margins. The margins has been in gray. In gray, it's been improving significantly. On the other hand, again, Hyundai's been going down, 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 down in gray. And same thing with Volkswagen. It's more consistent. It's flat. And so, three common traits of the automobile industry is the fact that their asset turnover is decreasing in blue, all of them. Meaning that they're not able to turn over their assets as fast as they want. So maybe that's something that management should target and improve when their restructuring happens. So how did GM do so well? Well, the fact that when you look at their ROE decomposition, they're able to not only improve on their operating margins, but at the same time be able to leverage that skill set by taking on a whole bunch of cheap debt. So right now, historically, GM is around the half point in this yellow line here, around 5 times leverage. And Hyundai, they didn't leverage as much as Hyundai nor Volkswagen. But Volkswagen right now, to sustain their ROE, they have been at historical leverage values. So that's something of a concern. So that's how their ROE is decomposed. This is the breakdown of the DuPont analysis. Their cash flow, another very interesting thing that we look at here, is how their cash flow is composed. The other two, not too important, right? It's just very volatile. It seems like their cash flow for investing is very volatile, meaning from our perspective, they're only doing a maintenance CapEx investment. On the other hand, GM, we believe, is doing a long-term, new facility, new growth-based investing for the future revenue. So this could be some future potential revenue that's going to come into the company. On the other hand, Hyundai and both Volkswagen is not engaging in such activities because it's very risky. So to fund such projects, GM has taken a lot of debt, as you can see in the color row, the pink color up there. And so that's where bulk of their money is coming from, and so is the other ones. And so if you look at the debt distribution and the maturities of these debt, we can clearly see that Hyundai is going to face a mounting short-term debt maturity in the near 3 to 4 years. On the other hand, we have GM, it grows, but not as significant as Hyundai. And so, what does this mean? What does this mean? Well, the refinancing risk is prevalent. It is there. Why? Because the United States government, right now, the Fed is increasing interest rates. So that means that companies like these, which is run on right now at 200% debt to equity ratio for GM, and 101% debt to equity ratio for Hyundai, so not as much, half actually, 169% for Volkswagen. That means that for them to refinance these debts, it'll be much more difficult because the banks will not allow them to do that at such low interest rate. And we can see that they're paying very low interest rate through their EBIT over interest expense, their interest coverage ratio. The interest coverage ratio of GM stands at 19 times. It can pay its interest 19 times over and over again. Hyundai, very good at 22, and Volkswagen, very abysmal at 5.34. So, another way to look at their future refinanceability is to look at their net debt to shareholders' equity. That's basically interest-bearing liabilities minus the amount of cash that they have divided by shareholders' equity. So we can see that GM has negative 18%, meaning that their cash is able to clear the entire debt right now. On the other hand, Hyundai, their net debt to over shareholders' equity is positive 60%. That means that their cash is not able right now to pay off their debt, meaning that they need to refinance with new debt to cover that debt. And Volkswagen is doing a fantastic job too. Even though they have very high debt to equity ratio, that means that most of it is interest-bearing debt. And so Volkswagen also at negative 20%. And so our conclusion is that Hyundai, underweight, super shorted. And then the other Volkswagen and GM, we want to long it, we want to overweight it. But in terms of the fundamental management perspective, management for Hyundai needs to restructure the manufacturing process to improve operating margins. As you saw, that EPS is going down, and that's where the ROE is coming down too. And management is under serious refinancing risk due to the rise in U.S. interest rates because Korea and Korea has that too. And so Volkswagen management seems to be comfortable in the status quo. We saw that their growth is flat, and management needs to be more aggressive and plan for the future generation of the automobile industry. That's the cash flow statement that we saw investing. And so what that is that the company has too much cash. And it stands at $48 billion, which is about 68% of their market capitalization. And that means that the management needs to either do a payout policy as dividends or reinvest that money into such how GM is doing. And so that's why we're overweight in that sector. We're long in that sector. And for GM, we're extremely long, and because their management have been effective in improving operating margins and leverage the upside by loading on cheap debt. And so management also seems to be engaging in new CapEx investment for future growth. However, the future cash flow, the free cash flow of those future revenue is still questionable because we don't know if electric vehicle is going to be the next thing and how that's going to take off. And lastly, management needs to reduce debt, some of that debt, because the refinancing will raise liquidity crisis in the future with their working capital. So thank you very much.